Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today in the EIA show, we're going to have a lot to discuss. There were places that we were right and places that we were very wrong, specifically exports. So just to touch on exports real quick. So we were expecting exports to come in at about 3.5, just because we've been noticing it, and it depends on what the day or the month or what is happening in the market, where you'll have exports that are either weighted towards the end of the month or the beginning of the month. And we've been noticing that they've been very much weighted towards the end of the month. And instead of coming in at about 3.5 million, we came in at about 4.122 million. So just think about the sheer size. So we had a big amount of exports. And then as we were expecting with imports, we thought imports were going to drop just because Pad 5 had that big surge last week. So that wasn't all that surprising, but it was the export side that really pushed through, which is something that we think is going to adjust as we go through the remainder of this week and into next week, because we should get a little bit residual, but it seems like a lot of that paperwork, a lot of those things were moved through at the very end of the month. So we should see some normalcy this month returning, but we should continue to see some draws going through, but we'll talk about that in a minute. One of the things that we wanted to touch on is always starting with the curve and see where things sit in general. So as you can see, it's still pulling forward in terms of backwardation, where you're best off to sell at the front. The thing is, when people talk about being bullish, the reopening trade and whatnot, that's when you have to look at, okay, well, what is the better contract to buy? And that's where, if you're looking to position yourself, you should really start looking further down the curve, where if you're looking at something in terms of December, you can get something at a better premium if you think there's going to be this big surge higher, and that would be a good way to position for it, just to give some components. The curve in general continues to get pulled up. Now you can essentially through April of 2024 is trading above 55. You're well above 50 as the whole curve has continued to shift up, which again speaks to some of the projects that could start getting talked about when you start looking at things. Again, this is not a prediction. This is just something that shows you what you're capable of doing in the open market. So that's just, you can see the shifts in general. But then when we look at COVID, some of the COVID things that we're going to talk about, we're going to talk about it more in the economy show. You can see the Asia Pacific is kind of holding flat right here. It's peaked a little bit, so we're hoping that you're going to start to see this come down a bit more. The U.S. has flatlined a touch, as has Europe. But on the other side, Germany and France continue to see a bit of a steady down move. Oktoberfest, unfortunately for those that have been, was canceled again in Germany, so that's going to impact some capacity, with Spain seeing a little bit of an uptick of cases, so that's going to be one to watch. India is the one, obviously, that's in the news, with Japan extending their emergencies past when they're supposed to expire, so you're going to see an extended emergency action in Japan. South Korea continues to see an elevated case count, with Taiwan also seeing an elevated case count. So that's, one of the things that we've been talking about is Asia in general, because it typically starts in one country and then spreads. And just how slow it's been with getting some of these, the vaccine rollouts in a lot of these different countries, which we'll talk about in segment 2. That's going to hurt some of that demand that was supposed to come back specifically in Asia. And now there's a news article going around talking about Seychelles, which is the most vaccinated country in the world, but it used Chinese vaccines. And right now we're actually seeing case counts go back up and curbing some activity. Again, small sample set, but just something to watch when we're thinking about what does the reopening look like, the acceleration. And then when just kind of putting India into context, and we'll have charts on this in segment 3, because segment 3, we're going to go through more on the OPEC side, pricing, Saudi Arabia cut OSPs. We'll talk about that and what's happening with Russia and what they're doing on those flows. But India March diesel exports rose 3.8% year over year. India March crude imports fell 6.4%. In India, March gasoline exports rose 13.1%. So those are things that we're going to talk about, and we think they're going to accelerate, which is going to lead into what's going to happen within Europe and the U.S. when we think about the Atlantic Basin, because a lot of the product so far is going to be slated to come into the Atlantic Basin. So just looking at crude stocks in general, so without looking at SPR, we had a draw of 7.99 million. Factoring the SPR, we had a draw of 9.04 million. And because we have the SPR getting sold into the market, differentials for Mars Blend and Poseidon against NYMEX, oil futures sank to the lowest levels in 10 weeks as you continue to see these tenders. So that's also going to help some exports, just because you're going to have refiners choosing to use one versus the other. And this is going to be one that will skew some of the data, but we're going to get a lot of that normalcy. We'll get a little bit more noise this week, and then next week we should start to see some of that normal behavior. Now, when we look at what drove the draw, clearly it's Gulf of Mexico, pad 3, when we looked at, there was a draw of 10.4 million barrels with builds in pad 2, pad 4, and pad 5, and pad 1, or the East Coast, down 1 million overall. But then when we look at the year over year, so year over year, we're down 47.1 million barrels. And then when we look at the 5-year, we're down 18.2 million barrels. Pad 3 still has a long way to go. We're still 15 million above the 5 years, so that's going to be one to try to manage. And then Cushing came in at 250,000 with, but it's still only 9.9. It's still 9.9 million below the 5 year. That's one that we were talking about, where we expected to see Cushing kind of go flat for the most part, just because we have a little bit of move in terms of what's happening in imports and exports, but at the same time, production, trying to balance that. As production stayed at that calculated number, that's one that we think is going to slowly start to grind higher as we go into the end of May and then into June, and then we expect to see some of that acceleration through June and July as these wells turn back on. We have a decent amount of frac spread activity that have normalized a touch here. Then when we look at, again, what drove the draw, because that's going to be the biggest component. And it's a big increase in the end of month exports, hitting, again, that 4.12 million a day, as imports dropped, more than expected. And the drop came to about 1.164 million. So that's going to be that capacity. And we think some of that's going to reverse. But again, we'll talk about that in a minute. Then when we look abroad, as the review of last week, you had stockpiles across the world that fell 5.3 million barrels week on week after seeing steady increases that happened in east of Suez for the most part, where now you're starting to see east of Suez, kind of rolling over a bit, but Japan is going to be the biggest concern, because right now, just based on what we're seeing, and we're going to talk about Teapot or Shandong, refiners are actually cutting runs again. So that when we look at east of Suez, we think we're going to see more builds as we go through the next 2 weeks, which is going to make some of these builds a bit sticky. As west of Suez, the ARA continues to see some steady creep higher in builds, but that's why when you look at just the excess, 1 million barrels current versus 5 year, but again, the 5 year, it's is that the right number, wrong number, but that's what people are using. So when you look at just the 1 million barrels current spot stockpiles, you can see that we're still well over where we should be at this point in time, and against that average. So the one thing that we want to talk about is just what is moving things. So Angola, as we've been talking about, Nigeria has seen a lot of slowdown, and that's really being driven based on what we're seeing coming out of India. And then Senegal offered to sell a cargo for late June, loading at a deeper discount to dated Brent via spot offer. So that's where we're continuing to see some of these issues. So the 950,000 barrel consignment for June 29-30 offered a 45-cent discount to dated Brent, drops from 20 cents on May 4th. So again, we continue to see this weakness coming in, especially in West Africa, which is speaking to the problems that we continue to see within Asia, as again, some of those Iranian barrels, bleed into the market, but that's displacing more Latin American and Norwegian. And that's where we're starting to see, West Africa as essentially this building point. And then that's going to lead us into what is going to happen in the Middle East. And that's where we turn to the road fuel recovery. So Europe continued to see some steady growth. That's actually flatlining at this level. But again, you can see how strong it's been off that bottom. Rest of Asia's continued to weaken. China had a nice bounce, but you have to remember China also had their May Labor Day, which was May 1st until today. So we're going to look at, okay, well, what is going to happen with China so far? We're going to talk about that in the EIA and the economy show, just because we did get more travel, but we had much less spending. So that's going to be a little bit of a conflict in terms of, well, what is the real number? And that's where we think China is going to kind of stabilize, not really fall down, but stay within this level as rest of Asia has come down a bit, with North America staying fairly flat. So just when we're looking at some of the more recent comments from India, and retailers suggest the full month's combined diesel and gasoline consumption will fall at about 20%. With more coming, where now the initial estimates were for a decline of 350,000 barrels a day of demand. Now we're up to about 690,000 barrels, and it keeps creeping higher as the issues continue to expand within India itself. And this is where we start talking about India, and you can see just kind of where those cases are. Lockdown index is actually going higher. Now, the other issue that we're starting to see is high sulfur fuel oil. So we're seeing a lot of high sulfur fuel oil that's come into the market based on the elevated storage. Now, high sulfur fuel oil can be cracked and used as feedstock. So it's going to become more economic, especially at prices here, where you'd rather crack the high sulfur fuel oil versus some of the crude cargoes. So that's going to be one to watch, as HSFO conversion economics have been more attractive than for heavy crude grades such as Basra. Downgrades estimated, again, this is taking us to that 670,000. But then the key Arab light grade for Asia was cut to $1.70 a barrel above the benchmark from $1.80 for May. That's the first reduction in official selling prices for the grade since December, signaling some market weakness. Now, the expectation was for it to be cut by 20 cents. So it's really not, it's a cut, which is just signaling a little bit of an easement. But again, it was even less than expected. So it's not a huge move in general. But we're going to talk about that in segment 3. But the last point here, when we look at PMIs, so India PMI, this is where we're expecting a lot of this to roll over, and as national mobility continues to shift down. And this is where that's going to impact not only just gasoline demand, but also that diesel demand, where diesel never really recovered. And now we're just going to see it start to roll back over. And it won't fall as far as gasoline just because it didn't recover to the same point. But again, these are going to be some of those issues that we're going to see that will impact U.S. exports and what is the available crude to come into our market. So then when we look against the 29-year average for crude, you can see that we're still at this elevated level. We're still off the low that was achieved in the beginning of, let's say end of February. And we should start to see a little bit of a normalization, especially because we normally get builds. At this point, we start to see some draws. So it's going to be a little bit slower. The rate of change isn't going to maintain this level. We'll still see draws. It just won't be at the same type of change that we've seen in so far, really the last 2 weeks. And then when we look at what is going to happen in the in pad 3, you can see that acceleration to the downside, where this is going to it'll continue to reduce. It just won't be at the same rate of change. And you might say, like, well, Mark, we actually had a small build, yet you said it was bullet. We had a strong rate of change. And the reason why is when we talk about imports, because Pad 5 has a significant amount of congestion at the ports. And there was that huge makeup number last week where we had expected some of that to come throughout the last 2 weeks. Instead, we kept missing it, and then it all came through at once. So that's where if you back that out and kind of normalize it, you can see that we've been fairly stable. And then this was a nice acceleration, which again will flatline a bit. And then when we look at Cushing, typically when we go over the last 15 years, you can see that we have a normal build going through this point, and then we start to see that those draws that accelerate through June, essentially just the summer months. as we get into summer driving. Now, so far, summer driving is there. It's just going to be, again, at that reduced level versus previous moves, but we will see an increase in demand. Like, that's just going to be what it is. It's just, this is the reopening. We're in the reopening right now, so you have to look at the data with that in mind, that we've seen a lot of reopening. There's still some more to come. But that's where we have to weigh the different aspects, because then what this is speaking to the imports. Imports were down pretty much across the board except PAD 4. But as we were saying last week with the 5-year average into PAD 5, PAD 5 saw a decline of 817,000 barrels a day, but it's still pretty much in line with the 5-year average, because last week's surge was just so large. We just expected it to come back into that normal range, where when we look at PAD 3 saw a decline of 123,000 barrels a day, with, again, against the 5-year average. That's 1.19 million off of the 5-year average, because they're trying to work through some of these inventories. So when you think about PAD 3 not importing, those barrels have to go somewhere, and that's where we continue to see this lag in the system, where all of these barrels are struggling to find places to go, specifically West African, and that's starting to bleed into the Middle Eastern grades. And now when you look across the rest of the board, you can kind of see where things sit in general, with PAD 1 down 116,000, PAD 2 down 172,000. Right now, what are we expecting? We're expecting PAD 2, 3, and 5 to see some increase. PAD 1 will see a small pop, but again, it'll just be closer to the year-over-year normal. Year-over-year, we were down about 31,000 versus last year. I think, PAD 1 will see some increase, but it just will be muted. So we will see a net increase. Our expectation was for imports to range between about, we kept saying 5 million to 5.5. We expected them to be a closer to 5.5, as we said on LinkedIn and Twitter. And here you can see that we came in at 5.45. So right on the nose, with the help of big O-RIN giving us some confidence in our views. Now, on the other side, when you look at U.S. gasoline imports from Europe, so U.S. gasoline imports dropped to an 8-week low. Even though it's into an 8-week low, it's still elevated for this time of year. But again, this is we had that big surge, and then we're seeing some of those slowdowns, which we'll talk about in segment 2. And just to give you an idea, in general, gasoline imports dropped to 337,000 barrels a day, which is the lowest since the 7 days ending March 4th. But that's where we're just at that 8-week low. It's just, we don't see it continuing to go down. We think we just flatline here, and then start to see a little bit of a steady increase, but not a huge surge like we have. It's just going to be at an elevated level as we go through the rest of May. And then when we look at crude runs increased 1.1%, breaking above the range. We were expecting to be closer to about that 85%. Instead, we came in at 86.5%. And you can see it was really driven a lot by PAD 2 and PAD 3. PAD 2 saw a big increase, getting much closer to the 5-year average, which is only 36,000 barrels a day away from. And then PAD 3 is essentially right back to where they normally are on a 5-year average, which again is also seeing additional pull through of that crude, which is a net positive in terms of the amount of crude in storage, kind of working this through. Now, we don't think that there's going to be another step change here. If anything, it's a small decline, but again, we've set that new push. We were thinking that we'd get to 87% by the middle of May. Clearly, based on this, we're still along those routes as we get towards that 87%. It just happened a bit faster. Let's call it a week earlier. Let's say 10 days earlier than what we were expecting. But again, along those seasonal norms that we would typically see at this point in time. Then when we look at implied demand was down 13,000 barrels a day in gasoline, which is a bit of a surprise. We were expecting a little bit of an increase, not a decrease, but again, it's that timing, because this is the calculated number. We do expect to see a move up and get closer to 9 million. Which just based on the data right now will most likely be this week, where we're going to push back to about 9 million and then stay around that level between 8.9 and 9 million as we go through and wait for essentially Memorial Day. Distillate had that pullback that we were expecting of 205,000. It's still going to stay elevated. There's still a lot of demand for disti, so that's not going to change. Jet fuel had a reduction of 101,000. That's a headwind that, again, we keep talking about is going to remain in the system with resid just flopping around a bit. But then when we looked at propane, that was up 204,000 barrels a day, which is really what we were expecting, a pretty steady level of, let's just say about that 1.3, 1. Based on the range right now, it's a bit wide, but we think we're going to average about 1.3, 1.4 million barrels a day of propane, propylene demand, which will be well above that 5-year average as well as the year over year. Now, European imports of clean product from the Middle East, mostly middle distillates, more than doubled in April. Shipments from India also climbed. By contrast, flows from the Americas slumped to the lowest in at least 3 years. But we'll recover a bit. So we're going to talk about what does that mean for exports, because some of that demand is going to, we're seeing some demand in Europe, so we're going to see some normalcy, but we're just going to see a lot of that filled from Europe, from Asia for Europe, from the Middle East into Africa and Europe, which again, the residual is going to make its way into the Atlantic Basin in general, which is going to hit some of our demand levels. And then European imports of clean petroleum products from India rose to their highest in more than a year. 6 tankers coming. Again, these are things then in general, when we look at from the Americas, Europe imports of refined products from the Americas, mostly middle distillate, plunged in April to the lowest in more than 3 years. The drop won't continue in May, with about 12 tankers that are so far slated to get loads. So again, that's going to be one to watch. Then when we look at floating storage in the U.S. on the Gulf of Mexico, you can see we're a small increase. We expect increases to continue, but it's going to be a seasonally normal average move up, but again at a very reduced level and still maintaining within that within the bottom of that gray line, that gray cloud. As you can see, imports, instead of here we were expecting this to remain closer to the bottom of the cloud, and not so much be inside of it, but be right along the bottom of it. Instead, we saw this step down. This is very much timing, movements, because if you have a lot of exports, then a lot of times if you're exporting, you can't import at the same time. So then we'll start to see some of this reverse. Again, not going to get back to the 5-year average for sure, but at least move closer to the bottom of this cloud. And if you think about why, you just have to look at the refinery run rates. As run rates go up, we should see imports continue to shift in that direction as well. Then when we look at PADD 2, we were expecting a decline, but realistically, we were expecting a little bit of an increase closer to that 5-year average to actually go above. But instead, it followed the seasonal trend. It just the rate of it increased. So this is one where, again, we think that there's going to be a shift, especially because PADD 2 refiners are running fairly hard, which they're going to require those imports specifically from Canada to provide that crude grade, which again is going to increase this and push us back above that 5-year average. Then when we look at just the overall utilization rates, here's where when we look over the last 29 years, we typically have a fairly steady increase in activity on a utilization side until we get to a peak in that July, and then either go sideways and start to decline. So we're still moving in the right general trajectory. You can see the rate of change is a little bit higher, but again, still moving in the right direction, getting us closer to, and I think in the proper direction of that 87%, right before we get into Memorial Day weekend, because typically refiners will prepare for Memorial Day push, so they'll run a little bit harder in front of it, then they'll pull back just because of the holiday to then go into kind of their normal summer season. So these are going to be things to watch as we go through the remainder of May.